Good morning or afternoon, depending on where you're joining us from today. We are here today to discuss the Secure Act as well as the Secure Act 2.0 and the impact that it has on our low-income taxpayers. My name is Angela Siener, and I am a senior staff attorney at Prairie State Legal Services in Illinois, and I'll be your moderator today. We are lucky to have two very knowledgeable presenters with us as well. So we have Stuart Simon and Bruce McGovern. Stuart is a tax attorney with the firm of Buchalter, a professional law corporation in Los Angeles and Irvine, California, where he practices in tax, business, and estate planning. Mr. Simon also holds certifications with the State Bar of California of legal specializations in both tax law and estate planning and trust and probate law. He's a CPA as well as a JD and has an MBT and an LLM in taxation. He is a past chair of the annual income tax seminar at Whittier Law School, past vice chair and treasurer executive committee of the tax section of the State Bar of California, former chair of the income and other taxes subcommittee on the taxation section of the State Bar of California, as well as the president of San Fernando Valley Estate Planning Council. Mr. Simon has lectured at the USC Tax Institute, the annual meeting of the California Tax Bar, in addition to multiple seminars and conventions. And secondly, Bruce McGovern is a member of the faculty at South Texas College of Law, Houston, where he also serves as the director of the school's LATC program. Previously, for many years, he was the vice president and associate dean for academic administration at the same school. He received his undergraduate from Columbia University and a law degree from Fordham University College of Law. He has served as a judicial clerk for Judge Thomas Meskill on the U.S. Court of Appeals for the Second Circuit in New York and practiced with the law firm of Covington and Burling in Washington, D.C. After that, he earned an LLM in taxation and taught as a visiting professor at the University of Florida Levin College of Law, and then began joining as a member of the faculty at the South Texas College of Law in Houston. The schedule for today, we're going to start off with Stuart, and he's going to discuss new early retirement withdrawal exceptions, the auto enrollment provisions, changes in de minimis contributions to employees, and lastly, improvements of the system for part-time employees. And then Bruce will be discussing the increase, the retirement minimum distribution age, student loan payments as elective deferrals, and several other items that may impact our low-income taxpayers. If you'd like to ask a question, please type it in the chat, and then I will be asking to the presenters as they come in. So if something comes up that you wanted to ask about, feel free to just put it in the chat and we will bring it up with the presenters. Thank you again for all of you joining us, and Stuart, the floor is yours.
Okay. All right, thank you. One quick thing I'm just going to cover, which isn't really on our subject, but I saw it Friday, it was released. The Treasury Inspector General for Tax Administration issued the trends and compliance activities for fiscal year 2022. And so this is a tax group. I feel these numbers might be interesting to people. During fiscal year 2022, taxpayers filed more than 161 million individual and 12 million business returns. The filings resulted in $4.9 billion of tax revenue during fiscal year 2022, which is 4.9 trillion, 790 billion more than revenue the prior year in 21. So that was the most revenue ever collected, 4.9 trillion. IRS collection activities, they had a good year. Their second best ever. They collected $72 billion in enforcement compared to what it was $58 billion in 2019. The revenue collection was primarily the automated computer system generated 74% of the revenue collected. One thing to note, that enforcement is $72 billion out of 4.9 trillion. Enforcement is about 1.4 to 1.5 of the revenue generated in the United States, which gets us back to the basic point that the United States tax system is primarily a voluntary tax system, the people filing returns. And the enforcement activities are important, but the reality is that voluntary compliance is the #1 feature in the United States. It's always a controversial issue. Okay, going to what we're supposed to talk about. Sorry for the delay. The 2.0 Act expanded the situations where taxpayers do not have to pay the 10% penalty under 72T for early withdrawals. There are several other exceptions made if distributions on or after a person's death, a person becoming disabled, medical expenses. Also, there's deductions for payment. You can take money out for a higher education. First-time home buyer also is one of the things that you can take $10,000 a lifetime cap for a first-time home buyer. The act also added an exception for emergency expenses. This is the new one, where you can take up to $1,000 for emergency expenses. This is only a one-time thing. You can take it again if you've repaid the amount. Otherwise, for 3 years, you're only allowed the $1,000. Well, they also added an interesting provision where you can set up an emergency savings account for up to $2,500, which can be set up by taxpayers. That's after-tax dollars. Another example that they came up with is, or a clarification actually, if you have a child born or an adoption, you're allowed to, per parent, per child, withdraw $5,000 without a penalty. In the original statute, which the Secure Act did not have a time limit on repayment. And the basic rule is that in the adopted, here's part of the statute, you have 3 years to repay the amount if you don't want to be taxed on it. Otherwise, these withdrawals, of course, are taxable income. The reason for the 3 years is that 6511 has a period of 3-year statute of limitations on claiming a refund from the time a return is filed. And they're using that as the time limit for the repayment. Another one of the rules they came up with to allow people to avoid the 10% penalty is if you have a federally declared disaster. If there's a federal declared disaster, you're allowed to withdraw up to $22,000 from retirement plans or IRAs without paying the 10% tax. And also you can repay this during the 3-year period and not have to pay income taxes. Another provision that they came up with in the hardship area is there was some confusion with the 403B plans as opposed to the 401K and the other plans. Now the 403B plans, which are public schools, charitable organizations, and so forth, you're allowed to withdraw under the same circumstances for hardship for 403B as you are for other plans. A new provision that came in, which is interesting, is you're allowed a penalty-free withdrawal for individual cases of domestic abuse. I think this is the first time domestic abuse has worked its way into the tax system that I'm aware of. The amount of the withdrawal is the smaller of $10,000, which will be indexed for inflation, or 50% of the participants' account. So this could be, a significant withdrawal if there's a situation where domestic abuse, you need to get rent money for a new apartment and things like that. It's something there which you'll be watching. And again, you have 3 years to pay it back if you don't want to have the income tax issue. Another area which is added in is terminal illnesses now. If you have a terminal illness, you can withdraw funds and not have the 10% tax on it. It's a recurring theme that the 10% penalty is onerous and they want to eliminate whenever they can. Another situation where you're allowed to withdraw now up to $2,500 is for long-term care contracts. If you get what's referred to as a quality contract, you're allowed to withdraw up to $2,500 per year without the penalty. And there's one thing just to mention, all these provisions that I've talked about so far are effective now. They're effective the date of enactment. So all these provisions are not for last year and for this year, you can avoid the 10% penalty because the date of enactment was December 29th, 2022. So you're effective there. Interesting thing from an employer standpoint, which is incredibly helpful, is that the employer can rely on the employees self-certifying that they met the hardship exception for the distribution. So that your employers don't have to go back and audit it now. they can have the employees certified that they met the exception, and they can make the distribution and not have to worry about the penalty. The other thing which is interesting here, is a small point. Employers are now allowed to give small amounts like gift cards, small de minimis financial incentives to have people enjoy and enroll in plans. Low dollar gift cards seem to be the thing, like from a coffee shop or some supermarket, something like a small dollar amount. And so that will not be a problem. The only thing that's interesting about that is I'm not sure that these de minimis amounts are necessarily going to be tax free. I was talking about that earlier, and historically, around Christmas time, companies used to give employees turkeys, hams, as free de minimis benefits. And those were way back to 1959. There's a revenue ruling 59-58, which said, yeah, if you give in kind a turkey or a ham or something like that for the holidays, we're not going to tax the employee on it. However, that was interestingly limited, that it's to the in-kind distribution and not a distribution of a gift, giving someone a gift card. If you give someone a gift card of $25 to the local supermarket, as opposed to giving them a ham or a turkey, that technically is taxable income to them. So be aware that you may have some minor issues here with giving financial incentives.
Stuart, we have a question.
Yes, please.
Someone is asking if you could explain the process for self-certification and the hardship.
I don't think the regs have come out on that yet, but basically what's going to probably happen is there's going to be a form that comes out that the person says that they've met this, they have this hardship. Let's say it's I hate to say terminal illness as the one that's going to be probably the biggest problem. That they've had a medical report and that they have the situation, and they probably will require a signature under penalty of perjury that the foregoing is true and correct. And the employer will then be able to rely on it. I don't think I've seen a form yet that's come out on this, but we can probably get one out to people if they're interested. We can look at the forms and come up with that. Okay. The other two things, and these are probably going to have some very broader impacts more than actually the penalty elimination, is they're expanding automatic enrollment. The Senate committee basically decided that automatic enrollment, which first started in '98, has greatly improved participation by eligible employees, generally for Black, Latinx, and lower wage employees. Early study found the adoption of automatic enrollment increased participation in 401k plans by short-term Latinx employees from 19% to 75%. Other studies have found that dramatic increases in enrollment rates among younger, lower-paid employees, and the racial gap in participation rates is nearly eliminated among employees due to auto enrollment. So auto enrollment is a big thing here. The auto enrollment will take place. The current provisions that they're going to change are effective in 2025, after 2024. On the first day, you're going to have participation of at least 3%, increasing 1% a year up to no more than 10%. And employees, auto enrollment is not required for 401k simple plans or plans established before date of enactment, which of course was last year, and government plans or church plans and plans maintained by an employer less than 3 years, an employer with less than 10 employees. But this is expected to have a major impact on having more people enroll in plans where there's not. Because one of the major concerns is that when people reach retirement age, they have no savings. And so the goal is to encourage people to have savings for retirement. The other change, which also is this one is also going into effect. This one's pushed off to years beginning after December 31st, 2024, which is again next year, is the part-time employees. The current rule for part-time employees is if you're a part-time employee, you're at least 21, and you've had 3 years in a row of 500 hours of service, you're eligible to be in a plan. What they're doing is they're shortening it from 3 years at 500 hours down to 2 years at 500 hours. So they figure that this will greatly increase the number of people. So basically, that's like working 10 hours a week for 50 weeks a year. You're now eligible for a plan where normally it was 1,000 hours. So this should greatly increase the number of people eligible for plans. Part-time employees will be able to start saving a bit for their retirement. It's not going to be a huge savings, but at least it's a definite push in the right direction. And I think those are the major topics I had to cover. I think Bruce.
I have one more question for you.
Yes,
from
please.
the chat. It says, can you expand on hardship circumstances and amounts? Also, is the WD subject to tax but not the 10% penalty?
Yeah, the distributions are still subject to tax unless you repay the amount. On hardship, going back to hardship, we'll look at hardship very quickly. Going through my notes in reverse order. Let me just 1 second quickly. Let me just, when in doubt, look. Okay. I apologize for the delay.
That's okay.
Hardship circumstances, this is basically the Senate comments, which are the primary legislative source of materials. Provide that certain circumstances, they okay, let me go back to hardship. At least I got that one there. That's a self-certification issue. Okay, let me go there.
If you'd like, we can come back to this at the end if it's
Let me
easier.
come back to that again 1 second so I can pull it.
Yeah, we'll move on. We can move on to Bruce and
then I'll come back to that so I won't have people waiting, please.
That's fine.
Okay, that is.
Okay, Bruce, go ahead.
All right. Thanks, Angela. So I'm going to be covering a few topics today. The first of those relate to so-called required minimum distributions, or RMDs, from retirement accounts. So we've got 3 topics really related to those. And also I'll be talking about expansion of the Savers credit, which is a credit right now. It's a credit that appears on the tax return against tax liability. And finally, I'm going to be talking about the ability of participants in retirement plans to treat student loan payments they make as contributions they make for purposes of getting employer matching contributions. So let's start in the area of required minimum distributions, or RMDs. And the brief history here actually goes back to the original Secure Act. So as Stuart mentioned, the original Secure Act was signed into law at the end of 2019, generally took effect in 2020. And then more recently, we had the Secure 2.0 Act in December of 2022. And so we're talking about developments from both of those that are relevant to low-income taxpayers. And prior to the original Secure Act in 2019, the age at which required minimum distributions, or RMDs, had to begin from retirement plans was age 70 and a half. And recall the theory here is that generally the law is designed so that people cannot leave money indefinitely in tax-deferred retirement accounts and get the benefit of deferral on their taxes. So they have to start taking money out at a certain age. And for a long, long time, that was age 70 and a half. The original Secure Act increased that to age 72. And that was for distributions beginning in 2020 for those who turned 72 in 2020. And then most recently, the Secure 2.0 Act changed it once again, bumped it up to age 73 for those who turn age 73 in 2023 and for distributions in 2023. So that's the pattern: 70 and a half, then 72 beginning in 2020, and then 73 beginning in 2023. Eventually, it'll go up to age 75 under the law as designed. Now, here we have a bit of an odd effect, I think, of this change, and that is if somebody turned age 72 in 2022, they had to take an RMD, and generally you have to take it for that year by April of the following year. So that person would have had to take an RMD by April 2023. In contrast, if that same person turned age 72 in 2023 instead, they don't have an RMD for 2023. They're going to have an RMD for 2024 when they turn age 73, and they don't have to take that RMD until April of 2025. So it makes a big difference whether you turn age 72 in 2022 or 2023 as far as this change goes. So that's where we are now up to age 72. And the other reminder I would add is that recall the CARES Act in March of 2020 suspended RMDs for 2020. So there was no obligation to take an RMD for the year 2020. That was a one-year hiatus. Now, also recall what happens if you don't take an RMD that you're supposed to take. And what happens, right, is bad things. That specifically, that you're subject to an excise tax on the amount that you should have taken out, but did not. So if I'm obligated to take out, say, $10,000, and I don't do that, then I have to pay a percentage of what I should have taken out as an excise tax. Now, until, so this is actually the second topic related to RMDs, and that is that Congress in the Secure 2.0 Act changed the penalty for a missed RMD. That penalty for a long, long time was 50%, a very steep penalty. So if I should have taken out 10 grand, but I did not, I then owed an excise tax of $5,000. Congress reduced that in the Secure 2.0 Act down to 25%. And that 25% figure applies for RMDs beginning in 2023. So if a person was supposed to take an RMD in 2023 and did not, then they don't owe 50%, they owe 25% as an excise tax. Now, there's also in the legislation an opportunity to get that penalty down to 10% instead of 25%. And the basic requirements to do that are two. First, to bring the penalty down to 10% on a missed RMD, the person has to actually take out any RMDs they should have taken out but did not. And the second thing they have to do is file a tax return reflecting the missed RMDs, that is, including them in income and reflecting the normal excise tax. And they have to file that income tax return by the earliest of 3 dates. Those dates are the date of mailing of a notice of deficiency to the taxpayer, the 90-day letter. Second possible date is the date of assessment of the excise tax on the missed RMDs. So the earliest of those. Third date is essentially 2 years after the year of the missed RMD. So the way I tend to think about that is if you want to get the penalty down to 10%, you got to take them all out, include them in income, and file a tax return within 2 years of the missed RMD and before the taxpayer gets caught, right? Before they get a notice of deficiency or before the excise tax is assessed. So that's a reduction in the penalty on missed RMDs. The other observation I'd add there is my experience and my experience also in talking with practitioners about this issue is that people have had very good success getting those penalties waived, that is, requesting a waiver at the time they file the tax return. And nothing has changed about that. So we still got the opportunity to seek an entire waiver. But if for some reason that's not available, that's where we are. General penalty of 25%, maybe down to 10% if we take that corrective action. So on the topic of RMDs, so first, increase in age and also a reduced penalty. The other issue that has come up as far as the increase in age to age 72 is that the Secure 2.0 Act was signed into law very late in 2022, signed on December 29, 2022. And at that point, many of the custodians of retirement accounts already programmed their computers to kick out RMDs to people who were going to turn age 72 in 2023. The other problem that arose is there were, of course, a lot of taxpayers who did not get the memo, right, about the change in the age, who turned age 72 in 2023, and they might have taken out amounts in the early part of 2023, thinking, oh, I need to take my RMD out. But then it turns out they don't, because they're not age 73. So as we all know, there's an opportunity to, if you take money out of a qualified retirement plan, you then have 60 days to roll that money back in to either that same plan or another eligible retirement plan. But if somebody took money out in, say, January 2023, they didn't have to take out, and then realized in June that, hey, wait, I didn't have to take that out. It's too late for them to put that money back in. So the IRS issued a notice midway through 2023. That was notice 2023-54. And in that notice, they said, well, look, if you turned age 72 in 2023, so basically you were born in 1951, and you took out what you thought was an RMD from January through July of 2023, we're going to give you until September 30th of 2023 to roll that money back in. So that was essentially an extension of the normal 60-day period for rolling money back into a retirement account. So if I turned 72 in 2023, I took money out in February that I thought was an RMD, I had until September 30th to get that money back in. So we've got the increase in the age up to age 73, reduced penalties. The third topic related to RMDs is a new option that is available to surviving spouses who are the sole surviving spouse and also the sole designated beneficiary of their deceased spouse's retirement account. Now, when a spouse is the designated beneficiary on the account, the spouse so far has had a couple of options as to what to do with the deceased spouse's retirement account. One is that they could roll the money over into their own retirement account. And if they do that, there's a certain set of rules that then applies. Essentially, it's treated as part of their own retirement account, and the normal rules apply. A second option was to treat the account as essentially an inherited retirement account. But now we've really got a third option. And this third option, enacted in the Secure 2.0 Act, took effect, actually takes effect this year, I believe, yes, effective in 2024. And the rule that Congress enacted in Secure 2.0 says if a surviving spouse is the sole designated beneficiary of a qualified retirement account, which could be either an IRA or an employer-sponsored plan, then the surviving spouse can make an election to be treated as the deceased spouse for purposes of determining when RMDs have to begin. Now, this, I think, would be beneficial potentially to a surviving spouse whose deceased spouse was younger than they were. So, for example, let's say we have a married couple. Let's say that married couple is a husband and wife, and the wife, we'll imagine, is age 68. The husband, we'll imagine, is age 62. The wife is the sole designated beneficiary of his retirement account, and he then passes away at age 62. She's now able to make an election to be treated as her deceased spouse for purposes of determining when she needs to begin taking RMDs from that account. So she's age 68, so left on her own, she'd have to start taking RMDs by age 73 in 5 years. But if she makes this election, she can elect to be treated as her deceased spouse who was age 62 So she's now got 11 years until she needs to begin taking RMDs. So I think that's the potential benefit, is it allows the taxpayer to leave money in the account for a longer period of time, get the benefit of tax-free deferral, and then start taking it out in the form of RMDs. Now, here are, my experience at the low-income taxpayer clinic at South Texas College of Law is where we usually see issues, of course, for low-income taxpayers is not that they want to leave the money in longer in the retirement account, right? It's that they pulled money out prior to age 59 and a half, and they're subject to penalties. And that's where these new penalty exceptions that Stuart talked about really are potentially beneficial for those who are terminally ill or a survivor of domestic abuse. Or the emergency withdrawal, for $1,000. So those are the
Bruce,
developments on RMDs.
Related to that, and Stuart, you can be on for this too if
Okay.
you, depending on who wants to answer it. Are all hardship exemptions now subject to 3-year repayment, or is it just the new ones?
That's,
My recollection, Stuart, is that's almost sort of on a each one is different as to whether you get 3 years or not. But what is your recollection?
I think most of them are 3 years.
Mm-hmm.
The reason being, it goes back to 6511 that you have 3 years to amend a return to claim a refund. That if you repay it, you're allowed to go back and get the refund. Most of the examples seem to tie in to the 3-year rule.
Mm-hmm.
The domestic abuse has that. The
emergency one
has that. The childbirth is there, or adoption. So I think the general rule is probably the 3 years or the most common. We can check. But I would definitely check if on a case-by-case basis to make sure when you're relying on an exemption, what your repayment period is.
Mm-hmm.
Just to be safe.
Yeah.
Okay.
And
okay.
Go ahead, Steve.
No, just on the. Do you want to talk about the hardship? What is the hardship now or a little later?
Well, we could talk about that now.
Okay.
So while we're on this topic.
Okay, just briefly, I'll hit it. Hardship. The IRS has a website which has frequently asked questions regarding hardship, and generally hardship exceptions are unforeseen emergency, imminent foreclosure, eviction from a home, medical expenses, funeral expenses, things caused by sudden unemployment are going to be emergencies. Generally, a purchase of a new home or payment of college tuition is not going to be a hardship for this situation, but there is a particular provision that allows you to put full money out without the penalty to pay higher education, and also there's a provision to allow you as a first-time home buyer. So the basic things that are hardships are going to be like medical expenses, problems due to sudden unemployment, illnesses, and deaths. Those are the main things. The question, if you're looking at what a hardship is going to be, it's like I said, if you're looking for the materials, it's at frequent retirement plans, FAQs regarding hardship distributions. It's on the IRS website. It's probably the best place to look for that. Okay, sorry to interrupt.
No, I think that's a good point. And one thing we also might keep in mind is that although we have these the federal tax rules as to how these sorts of distributions are treated, the plan itself has to permit various types of withdrawal. So in other words, the fact that Congress has said there's no penalty for a particular kind of distribution doesn't mean the person will necessarily be able to take that kind of distribution. They're going to have to check with their plan to see if it has been amended to permit that. So I'm going to move on to the Savers Credit, which was modified by the Secure 2.0 Act in December 2022. And it's been changed by Secure 2.0 in a very significant way. However, what I would also say at the outset that we should keep in mind is this particular change I'll discuss takes effect in 2027. Okay, so we've got a few years where the current rules are still in effect. Now, generally, what this change does is it converts the existing saver's credit, which is a credit taken on the tax return, the individual files, into a contribution by the federal government directly into the individual's retirement plan. So in other words, it will no longer be something that is connected to the tax return as a credit. It's going to be independent of the return, and the government will make a deposit directly into the person's retirement plan as a percentage, essentially 50% of the first $2,000 that individual contributes to the retirement plan. So therefore, we can see the maximum amount that the government will contribute would be 50% of $2,000 or $1,000. And it's going to be called the Saver's Match. The Saver's Match. That's what takes effect in 2027. So let's begin with just a very brief overview of the current Saver's Credit and how that works. The Saver's Credit, keep in mind, was in effect for 2023, still in effect for 2024, and will still be in effect for 2025 and 2026. And then starting in 27 is when the new rules take effect. And the way this current Saver's Credit works is that if an individual is below a certain income level, their adjusted gross income is below a certain level, then the individual can claim on the tax return a credit against tax liability that's equal to a percentage of the first $2,000 that the person contributes to an eligible retirement plan. So this is a credit designed to incentivize contributions to retirement plans. This could be to either an IRA or to an employer-sponsored plan. Now, generally, just to give you some idea of the income level under the current rules, for a single individual, that is $36,500 of adjusted gross income. If you're married filing jointly, it's $73,000. And if you're head of household, it's in the middle at $51,000. So if you're got AGI at that level or below, you're eligible for a Saver's Credit. So it's a percentage of the first $2,000 contributed by the person. That percentage is either 10%, 20%, or 50%. So notice the highest credit there, again, is 50% of the first 2,000 or 1,000. So 10, 20, or 50. The specific percentage of the credit that you get is depends on the person's level of income and filing status. So if somebody's contributing the maximum amount per year of $2,000 to their retirement plan, they're going to get a credit of either $200, $400, or $1,000 on the tax return. The current credit, the Saver's Credit, is non-refundable. So the most it can do is eliminate tax liability on the tax return. It cannot generate a refund if it exceeds tax liability on the return. Now, the Saver's Match, which is what Secure 2.0 changed this to, and will take effect in 2027, again, will no longer be a credit on the tax return. And instead, the federal government will make a contribution directly to the person's retirement plan. And again, that contribution is going to be 50% of the first $2,000, so $1,000 credit. In that sense, it's a bit simpler than the Saver's Credit. We don't have 10, 20, or 50. It's just 50%. And also, it is now going to be the equivalent of a refundable credit. And what I mean by that is, as long as the person contributes the $2,000 to a retirement plan, even if they have zero tax liability on the tax return, they still get a contribution by the federal government into the retirement plan. So it's something that would not happen with the existing Saver's Credit. Now, the Saver's Match, the future rules, will also be limited to individuals with adjusted gross income below certain levels. And essentially, the way the Saver's Match works is that the amount contributed by the federal government will be phased out as adjusted gross income rises. And specifically, a single individual will lose this entirely at 35,500 of AGI. Somebody married filing jointly will lose it at 71,000. What was interesting to me is those figures are actually slightly lower than the figures for 2023 under the existing savers credit. And here we are talking about rules that'll take effect in 2027, right, 3 years down the road, and the AGI levels are a little bit less. But they will be adjusted for inflation going forward. Now, what's also interesting to me about this particular regime is that the match contributions that the government makes, and that's how we might think of these. It's almost like a matching contribution by the federal government, right, as a percentage of what you put in. They will not be subject to reduction or offset to pay child support, federal or state tax debts, just other federal agencies like student loan repayments. So in that sense, this also is different from the current regime, where there can be an offset on the tax return. So that's welcome, I think, for low-income taxpayers and the clients that we serve in the low-income taxpayer clinics. Now, what's a problem that I also foresee arising is we're now going to have this regime where the federal government is, putting money directly into people's retirement accounts, almost in a similar way to what they do with, like making a direct deposit of a refund now into a checking account, right? And so I can imagine there are going to be situations where a contribution goes into the retirement account where it turns out the person's not eligible for that, right? Their income was too high, something like that. And what will have to happen in that case is there's going to have to be a reconciliation there, and the person will actually owe back any amount that they should not have received. So they're going to have to take that out of the retirement account and pay it back, or leave it in the retirement account, right? But come up with other money to pay it back. And that'll be done through the mechanism of the tax return for that year. So in that sense, it's a bit like the reconciliation of the premium tax credit under the Affordable Care Act, where you get amounts in advance toward your health insurance, you then file a tax return for the year, you have to reconcile, and if you got too much, you then owe it back at the time that you file that tax return. But I think very interesting, and again, this is designed to really encourage people to make contributions to retirement plans and provide for their retirement. Last topic I want to mention, this one just a bit briefly, is that under a change made by the Secure 2.0 Act, that individuals will be able to treat their student loan repayments, the payments they make on student loans, they'll be able to treat those as contributions they make to a retirement plan, an employer-sponsored plan, for purposes of the employer making matching contributions. So I think the theory here is that for people, especially low-income people with student loan payment obligations, they're really not in a position to contribute amounts into the retirement plan as well, right? Because they've got this large cash outflow for the student loan obligations. And if that's happening, if they're not contributing into the retirement plan, they may be missing out on matching contributions from the employer that they could be getting. And so this is a really welcome change. This kicks in for plan years starting after 2023. So it kicks in this year. And essentially, this is now a benefit that the plan itself will have to offer to employees. So employers will have to amend their plans to offer this. But if they do so, then if the person makes, say, $1,000 a month as a payment on their student loans, they've paid 12 grand, that can then, under the terms of the plan, be treated as if that money had gone into the employer retirement account for purposes of the employer then calculating what matching contributions is that person entitled to. So I think that's a welcome development. The main restriction is it's got to be a qualified student loan payment. So the typical student loan payments should not be any issue about those qualifying. So that's our last topic for today. So Angela, I don't know if we've got other questions or comments that have come in.
At this point, we do not have any other questions. If anybody has any last minute questions, feel free to type them in the Q&A box. I'm sorry that I said the chat before, but apparently we need to use the Q&A box. Several people have found that. But if you do have any questions, feel free to type them in. We'll give a minute or two to see if anything comes in, and then to see if you guys have any, do you guys have any closing thoughts while we're waiting?
Just that I think we are all at this point just getting familiar with the rules that have been enacted by Secure 2.0 and even the original Secure Act. And so for that reason, I think we're sorting out what the rules are. We're going to see lots of issues come up over the next few years as we deal with these.
Great.
Right.
We had a couple comments come in. One is on your last point, are employers required to amend the plans? Or is it going to be a voluntary thing?
So generally, employers are not required to amend the plans. This kind of gets back to the point we were talking about earlier, that simply because Congress provides for a favorable rule or an exception to a penalty doesn't mean that the plan has to offer that. So the plan does have discretion as to whether to offer this. And so, for example, in the student loan payments being treated as contributions, I think employers will be looking at that and asking, well, is this something that we need to really spend the time and the effort implementing? Do we have in our workforce people who would, a large number of people who would benefit from this? So yeah, it is voluntary.
One last comment. This is not a question, just a comment. Great info. Thank you to the panelists for taking the time to share this info. So I want to thank you as well. And I want to thank everybody for coming today. If we don't have anything else, Stuart, did you have any last comments?
Just the last comment is this: a lot of these provisions are going into effect in later years. Some employers probably will have to amend their plans for certain things like expanding the auto enrollment and the part-time employees. So it'll come down to a lot of it. The employers may not have to add the provisions for the student loans and other issues. But if you have clients who do have plans, they may want to think about, as they have to amend their plan for certain provisions of Secure 2.0, they may want to think about adding these other provisions at that time. Because there's certain things like the part-time employee thing that they will have to amend for that if they don't already have it. And so that when they do the amendments, the plans, they may want to look at adding on various provisions for emergency withdrawals and things like that. It's going to become a question of, as Bruce mentioned, the burden on the employer and the plan, where they want to take on that additional burden. But they will have an opportunity to amend their plan sometime in the next year or two to take into some of these other changes.
Great. The only other thing that was asked was if there were any written materials for this presentation. I didn't know. I know Amit's thrown a bunch of stuff in the chat, so you could probably check there for some places to look. And a lot of this is coming from the code, so I don't know if you guys have anything you wanted to share. Otherwise, we can just kind of.
I think I mentioned the Senate summary, which is a good summary. And the materials on the IRS website for the emergency withdrawals and those issues are, we looked at those, the withdrawals without the 10% penalty. Those look like they've been updated also for 2.0. So
yeah, and we can share, we can email out, if you guys would like, we can email out as a follow-up to this, the stuff that was shared in the chats in case you did not get a chance to take a look at all of that, if that works for you. But yeah, there aren't any other questions. So thank you all for coming today. And thank you to our wonderful presenters. That was very informative. I know I learned a lot. And yeah, thank you all. Have a great day.
Okay,
All
thank you.
right. Thanks so much, everyone.
Okay,
Bye.
bye.